Hi again, I'm Kortsch from the Monetary Trust Initiative, and let me walk you through this once more. What we're trying to figure out is how to pay for our infrastructure that we desperately need without debt. So I'm rolling 4 points together: infrastructure, our monetary system, you've got to understand that, otherwise it won't make any sense, then the rate of inflation, and the balance sheet of the Federal Reserve Bank. How do all those work together? Well, in the last video, we looked at the infrastructure and came up with a conclusion that here in the United States, would probably be similar around the world. We get a D+. That's not a B as in Bravo, that's a D as in Delta, which means we're failing. And the total amount needed over the next 5 years is $3.6 trillion, of which approximately $2 trillion has already been planned through taxes and bonds, leaving a funding shortfall of $1.6 trillion. All right, we finished with infrastructure. Let's move on to the second major point, which is the monetary system. How does it work? Let's go through that. Number one, what I'd like to do is talk very briefly about the difference between the two words, fiscal and monetary, are routinely confused. Fiscal has to do with budgets. For instance, the budget of the federal government, that's fiscal. Of your state, that's fiscal. You could even say your own personal budget. Monetary has to do with our overall money system, how money is made. It has to do with aggregates, these $63 words. Aggregate simply means everything all thrown in together. Has to do with price stability, has to do with regular banking, has to do with central bank actions. That's the monetary system, okay? So that leads me to another point. What I'd like to do is talk about the difference between policy and system. Janet Yellen, or the Board of Governors for us here in our central bank, the Federal Reserve Bank, they regularly put out statements as to definite actions, potential actions, what they might do in the future. That all has to do with policy. A lot of us glaze over when we listen to those because we don't really understand how the system works. And if we don't understand how the system works, their policy descriptions aren't going to make a whole lot of sense. So let's start. Maybe it's the wrong way to start, but what I'd like to do is talk about popular misconceptions. How does the average person on the street think this money system actually works? But you know what? It doesn't. So I want to shoot a bunch of holes in how 99.99% of us think. So number one, most people think it's the central bank or the Federal Reserve Bank that creates our money. It isn't. That they actually print the money. They don't. I know on television we constantly see these pictures, of printing presses running and they're printing $20 bills or $100 bills. Well, of course they get printed somewhere. Treasury actually prints them. But it's not the Fed that creates our money. The second wrong point is that QE, quantitative easing, which we've now done to the tune of $3 trillion over the last little while, is just printing. They're just printing money. Well, actually, no, that's not money that ends up on the street. That ends up being reserves for the bank. And you're going, whoa, 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 whoa. I'm going to walk through that later on for you, okay? And the next point that I get routinely is that QE leads to hyperinflation. Inevitably, this is going to lead to hyperinflation. Because you see, the banks have the power, according to the money multiplier theory, of multiplying this by 10. So, quote, QE, it's a bad mouthful, has created $3 trillion. You multiply that by 10, that's $30 trillion. That's half of the annual GDP of the whole world. Where's that money? Well, I don't see it. And you know what? You don't see it either. So this isn't working. As a matter of fact, I was at a conference at the Federal Reserve Bank recently, and we were dealing with some of these issues. And at the end, I got up and asked a question to a panel. I said, okay, ladies and gentlemen, what would you say, this is to the panel as a whole, is today's money multiplier? And one of the people, if you'll pardon my language, this is an exact quote, he said, hell, it's 0. What he said is not a single penny of QE is going to end up in your pocket. The fourth item that we get very confused about is we think that banks actually take money from savers and convert those into loans for people who want to borrow money. They intermediate's the big fancy word. Let me tell you, categorically, absolutely, banks do not intermediate. Banks do not take money from savers and then lend them on to borrowers. It does not happen. the savers do not come first, they come second. Whoa, this is crazy. We're going to go through this. And the fifth item is that so many of us here in the US think, well, we're different. Our system is different. No, it's not. The whole world, there are some exceptions, but the whole world works on this kind of a monetary system. And I want to end up by giving you a quote from the Bank of England just to tell you, I'm not crazy. I didn't make this up, all right? By the way, I'm quoting the Bank of England because I tried to find some succinct quotes from the Federal Reserve Bank, but I'm not going to sit here and read a paper to you, which is what would it end up being. So this is a short description that the Bank of England put out in 2014, and it's titled Money Creation in the Modern Economy. You can go online, Google it, you'll find it, and it explains what it is that I just told you about. Let me give you an exact quote. Money creation in practice differs from some popular misconceptions. Banks do not act simply as intermediaries, lending out deposits that savers place with them, nor do they, quote, multiply up central bank money to create new loans and deposits. It's the end of that quote. By the way, I go into much more detail on this in my book, and you can get it at any of the major booksellers or at Amazon, wherever you want to. The Next Money Crash and How to Avoid It. Ladies and gentlemen, thank you. I'm Kortsch with the Monetary Trust Initiative.